Good afternoon, welcome to the TheoTrade afternoon video. I am Blake Young and today is April 3rd, 2025, and we're certainly talking about a lot of volatility and a lot of selling that's gone on in the markets today because of the tariffs and because of the uncertainty that surround the tariffs. As we watched the market, we had a gap down, close down in all the major indexes across the board, but it doesn't mean there's not some areas that are bullish. As you can see, we've fallen back down on the S&P 500 right to this area that was a gap area. This is a barrier. This is an area between, and I would say between 535 and say 540 that I'm going to expect it to settle in. But if we break through that 535, I'm looking for a move all the way down to 511 over the next 2 weeks. But this is the area. This is an area that there could be some defense. It's an area that has had gaps and barriers and reversals. And so I'm just watching to see if this is sustainable or not. It looks like it is able to break free just because of the volume. We're probably going to hit about 140, 150% of average volume on today's sell-off. And that is definitely a threat to the support level. But we don't know yet. We haven't seen where it's going to go. So my question is not whether or not it's going to break free or not, because we'll have to see what that does tomorrow, but whether there's opportunities in other areas. If the tariffs are highly inflationary, we're going to be looking for a bounce in energy, which would mean oil and gas producers, a bounce in real estate, a bounce in commodities, and a continuation of consumer staples. Right now, the uncertainty has pushed money around quite a bit, but the inflation aspect of that should benefit those sectors. If we look at the performance today, our performance today seems to be supporting consumer staples, healthcare, utilities on the way up, and definitely be pointing to more bearish or downside to technology and consumer discretionary. And if we look at consumer staples ETF XLP, you can see that we've gapped up and closed higher from yesterday, including all the volatility that happened. We actually started the day higher, did test a low, but closed higher. So this is showing that we have follow through with good volume, 150% volume in the entire sector ETF. If we look at individual stocks inside of there, we might be surprised to see dividend aristocrats like Coca-Cola breaking through its 52-week high. Now, we did break free and pulled back. We're right here. I think this is a good place to have a lower cost entry. And I'm not looking for this entire move like the 60 to 73 area, but I would definitely start the target from 68, 73, looking for about an 8% continuation higher on a stock that is going to pay a dividend. And that should happen in a matter of a couple of months as far as getting the 8% gain. Your dividend is going to be out probably into June, so the goal would be to participate in the long-term trend while waiting for that dividend to pay out. If we look at other stocks inside of consumer staples, we could look at something like Dollar General that has broken out aggressively today, gaining 5% on the day. It has pushed through this original gap, so the close up, theoretically, we could go for the entire move all up to 123. I would cut that in half and assume that you're probably going to get somewhere into the 110, 112 and play out this head and shoulders-ish pattern, which would go from 70 to 85. We could look at that as a 15 to 20 point breakout, and again, that's 105 to 110 on Dollar General. Utilities and healthcare maintained for most of the day, but we did drift lower, and so the breakout looks like a failure at this point. I would want to see a further confirmation in both healthcare and in utilities on a higher close, but I do think there's some opportunities bullish in this sector. It just didn't sustain its breakout today, and so I would like to see these both push higher before stepping in there. And if we look at real estate, which generally does well in an inflationary market, we're down here at support. I want to see this fail to break through 40 before I start looking for buying opportunities. Otherwise, I'll look for this as a selling opportunity back down to 39, and that's where I'll look for the previous highs, gap, and lows as an opportunity to look for a new setup in real estate. You'll note that oil has fallen back about mid-channel between the 68 and 78, that we went up about halfway. We reversed right back into the 68, 66 level where I have continuously watched as a support area. So if we can see oil stop falling down here near these lows at 66, 67, which is an indication of lack of demand, if we see that it defends this level, a bounce here could take us all the way back to 72 and all the way to the top. But I'm going to look for energy stocks in the energy sector to benefit on that bounce. And the bounce for energy could happen here, but I do think it wants a little bit lower, maybe around 84, 85. Again, these are not set up today, but these are the ones that'll benefit generally in the long term due to inflation. So let those pull back and find the levels. Right now, I'm only looking for consumer staples, utilities, and healthcare. Consumer staples are already giving us confirmation pushing higher. Utilities and healthcare need a little bit of confirmation, and energy and real estate still probably have a little bit of a pullback before we set up the bounce for those to go higher, and that's a little bit longer term. As we look at those that are very bearish, such as consumer discretionary. Consumer discretionary gapped down and closed below the recent lows. There really isn't much to defend here. We've already crossed through the highs, the lows, the lows, the lows, and we gap down and close down on high volume. And so this does look like we have some more potential. And I'm looking for about 185 and maybe as low as 180 before I start looking for bullishness in consumer discretionary. But for me, this is an opportunity to take the breakout. 206 down to 193. That move is about $13. It's about 8% continuation lower. And we gapped again to the support level and continued lower on the close. Even though Apple's listed as a tech stock, I'm going to list it as a consumer discretionary opportunity because people buy Apple if they are confident in looking to buy stuff. This would be something that fit in both technology and consumer discretionary since it's such a consumer electronics product. And you can see the gap down traded below that low and closed down, and the impact of the tariffs are probably going to be a lot deeper in Apple than many other electronics companies. And so we're looking at this, a breakthrough 202. I'm looking for 180 on Apple, and we could see about a 10% drop from the current price, and that 180 will give Apple a 30% correction off its highs, one of the biggest pullbacks we've seen in Apple in a very, very long time. Inside consumer discretionary, we also list stocks like Lennar. Lennar is a housing company and a home builder, and you can see we broke free from this low, and I don't want to chase this one, but I do have some long-term targets. So we've made lower highs, lower lows, lower highs, lower lows. We put in a 52-week low. I'm not afraid of buying 52-week highs or afraid of selling 52-week lows. I just need to have a target and risk management. And so the next target I have for Lennar is about 103, so maybe a 4% decline. I do think it could go for 100 and get back into these levels. So it could be 7, 8%. But it's a little bit trickier to risk manage off of that, because I do think you need to go back up above today's highs. And so you might be risking worse than 1-to-1 on the Lennar. So it's not my favorite, but I do think there's more downside. In addition to that, since we've talked about the impact of the tariffs, you're going to have stocks like GM and Ford. And GM and Ford are poised to break down through here. We saw the gap down, close down. And now that we're facing this support level, we should see about a 10% decline if we can get through this low. And I'm looking at 41 or 40 for GM. Ford is a lower price stock, a little bit harder to trade, but it's the same concept. We should be seeing about a 10% drop in Ford and dropping this one down to probably about 875 or 850. And we can go back and look historically and see that that is a 3-year low at 905. And if we can get through that 905, the 850 takes us back to 2020. That's kind of a low area that I saw as support and resistance back in 2019, 2020. And so that would be my bigger target for Ford. Now, the last one I'm going to share is one that I think it could go either way. Home Depot has sold off, gone from $450 all the way down to $350. So we've seen about a 30% correction already from its highs. But as we're looking at this move today, we gapped down, traded flat. As you can see, the market's still open, but we traded flat. This hasn't given me what I would consider a bear flag breakout. It hasn't bounced necessarily. It's sitting here at this key level. Home Depot does have costs associated with the tariffs in Canada, and they sell lumber. We get a lot of lumber out of Canada. This either can bounce and go all the way back up to 390, or it'll break and go all the way down. I'm looking for 15% move as a minimum, either as a bear flag or a bounce. I don't know which way it's going to go. And so I would use today's candle and say trade above this high, or if you want a little extra confirmation, get back through this gap. And if we get back through there or through the low, then I'm going to treat that as a 10 to 15% opportunity in Home Depot. I'm not sure which way it's going to go. I'm willing to take it either direction, up or down, bullish or bearish, off of this key level. And I think today's indecision on high volume shows there's a battleground right where we're at. And it may even be worth looking at buying a long iron condor, a long strangle, a long straddle, if the price is right. But I'm going to wait for confirmation and just take it one direction, whichever way it decides to lean. And we're finishing out the day almost perfectly flat with the last 2 minutes to spare. So there is still opportunity. Bullish in some sectors, bearish in other sectors, flat, and could be either way a coin flip in something like Home Depot. The drop in the market is not the end of the market. It is the opportunities of the market. It's just a matter of readjusting our view, setting our expectations, and trading with defined risk with specific targets. And I think if we do that right, we will be ready to manage our accounts and be able to manage the next opportunity. If you're looking at bonds, bonds are a place we can go, but I'd let those breathe back out. Look for things like TLT or IEF to fall back down. And if we find that stabilizes, there could be long-term bullish opportunities in bonds if we're still in a defensive mode.